Hi, good afternoon, everyone. Welcome back to the channel. I'm joined today by a very special guest, Marcos Mila. Welcome, Marcos. So glad to have you on this channel.
I appreciate it. Super excited to be here.
Yeah. So I just wanted to cover some things, we actually haven't discussed yet, like your investing philosophy and what you like to invest in and your favorite funds. So go ahead and talk about that.
Well, I appreciate it, you having me on, Coach. And my investment philosophy is just long-term growth investing. I'm just turned 25, so I really don't need cover calls to
Yeah.
generate me income now. I need the growth. So I don't want to cap my upside a lot or even at all. So I invest half of my portfolio is just in a plain old S&P 500 ETF, VOO. And then I have a good chunk of it elsewhere in QQQM by Invesco, just a tech fund, mainly technology fund. SCHD by Charles Schwab, another large cap growth fund. And then I have my next top holding is AOTG, which is another growth fund. You can see the theme here. It's all growth,
Yeah.
pure growth. And then I have a little bit of VTI, which is interesting because people would say, well, why do you have VTI if you have VOL? Because they're both like large cap. But it's because my 401k at the time only had VTI and not VOL. So I have a
Hmm.
little bit in there. And then a little bit of Bitcoin and gold with BTGD. And that's it.
Nice. It's funny you say that with the 401k. I ran into a similar thing with being constrained by what funds they offer. So that was why, for the most part, I had certain funds for years, actually.
Yeah. And I also believe in Roth IRA. So I have a taxable account, Roth IRA, 401k. So
Hmm.
try to max out the Roth IRA, or I will first, move the funds to 401k, whatever is left, taxable account. That's kind of my philosophy.
Nice. So do you max out like 401k, Roth IRA, HSA, all of that?
Yeah, I don't have HSA yet.
Yeah.
I should get one. But yeah,
Yeah.
I maxed out the Roth first, just for the tax benefits. 401k next, lowering my taxable income as much as I can. And then
Nice.
taxable brokerage account, just because I think everybody needs to have one. If you want to retire earlier, you should have a taxable account for sure. You don't want to be constrained to 59 and a half for all the retirement accounts.
100%. Yep. Yeah, I do a lot of the same. But interestingly, so what got you into like covering dividend funds?
Yeah, so I covered quite a bit of the traditional actual dividend funds, right?
Hmm.
SCHD, DGRO, VIG, HDV, Noble. There's so many dividend funds out there.
Oh,
I
so
was
many. Too
covering that.
many.
Yeah, it's too
Yeah.
many, but those are really good, high quality ones, right? You have the dividend growers, or stocks that grow their dividends year over year, high quality companies with some solid free cash flow. And then I started covering a little bit more of like cover call funds, the traditional higher quality ones like JEPB, JEPQ at the time. And then over time, I saw that there was the Goldman Sachs ones like GPIQ, GPIX. And then there was There was everything that we saw in the market. There was the Roundhill, Yield Max, Rex, Neos. Everybody out in the market wanted to get a piece of the cover call pie. So then I just started talking about it, and it started doing pretty well for me. And I enjoyed talking about it because I found out that, well, not found out, but these are super complex products at the time. And for even like Yield Max at the time, I couldn't quite wrap my head around it. But once it clicks for you, you're like, oh, that's what it is. Like that's how they generate the yield or the income. This is like the consequence of the yield. This is what a consequence of my upside. So once that clicked, I got super interested in wanting to educate people more about it. So then I had the interviews with all the fund managers, which I love doing. It's a lot
Yep.
of work to do though. Like it takes a lot of hours to prep of like their background, questions I want to ask. I want to make sure it's super valuable for people. And then, yeah, I'll tell you a story. So I went to a conference. It's called Exchange. Maybe you'll go next year. I'll probably some of the fund managers like to ask me like who we should invite.
Yeah.
I don't know why they asked me, but even for your event, you went to Stock Twits. So Will asked me like who should I invite, and I was like, here's a list
Yeah.
of people. Thomas, you're on that list.
Awesome.
So
Yeah.
there was a conference called Exchange, and I remember sitting next to. I'm not gonna say who I was next to because there was a fund managers and there were some other YouTubers, right? And they were like, cover calls are going to be like the biggest thing this year. like these are what we're going to launch or what we think people are going to launch. So this is what like content we should be making. So I remember like going there, like walking out of towards the airport, and I was like, all right, if it's going to be that big, then I don't want to be creating content based off like my own views. I want to interview the people that are creating these products and educate people in the right way. So start doing that, and I love it. It's so much fun.
Yeah, definitely. Um, it's interesting. So I've probably been covering the covered call ETFs a little bit longer. I found them in 2023 actually, and I found Tesla. That was one of my first ones. You might have seen. I just sold it actually. Um, because I actually believed, and I'm like, you know what? If I'm going to cover these, like I'll try these out and put a portion in. But over time, you might have seen in the video, it was basically the rate of return of a CD when you factor in total return. So I'm like you, I'm a growth investor. But when I saw the space on YouTube for high yield dividends and stuff, I'm like, I need to cover this too. And like you said, the fund manager said covered calls are going to be big, going forward.
Yeah, and it's interesting because I firmly believe that I enjoy it when a cover call issuer comes on the channel because then they can educate their investors. But I mean, there's this whole craze of like, do they own their own products? I want to ask you, like, what are your thoughts on should cover call ETF managers own their own products? Because I've interviewed all these people, been in some crazy rooms with net worths of like 45 million, 50 million, 80 million net worths of individuals, 30 years old, 40 years old. And these like wealthy people that I've interviewed talk to behind the scenes. I can't say who, I don't want to get in trouble, but they're like, nope, we don't own these cover call products. Or if they do, it's like a small portion. Like they have like a DGen portfolio where
Right.
it's like a small portion, but it's not even a cover calls. It's just like, trading at that point. But if it's a manager that has growth products, like for example, like a AOTG ETF, like the fund manager owns like the AUM is almost 100 million. He owns a lot of it, right?
Yeah.
So those people own it because they don't want to get the cover calls, but the cover call managers don't seem to own much of it at all. Besides like Neos, I know Neos owns a lot of their own
Yeah.
funds.
I did actually ask him that yesterday, and he said they did. I might be a little bit controversial here. I don't know. This might affect my next year's invite to, I don't know, the Yield Max event. I don't know, but like, I think fund managers should own what they produce. I think they should 100%. And I'm almost certain in a past interview with Jay, he told me they did. Um, so I don't know. I've seen some other videos, heard some other things that I haven't verified myself, but I 100% think if you issue a fund, you should own at least a portion of it. And like you said, what some of them are doing with like the DGen portfolio, in a sense, that's kind of what I did. I never thought about putting a huge amount into these funds. I have a 10% bucket that I call the speculative bucket. You could call it the DGen bucket, where I just experiment basically, and that's where all the yield max funds were. Since then, I've actually pared down some of those positions because you've seen my wheel strategy this year. I needed to actually take some like tax loss harvesting by the end of the year, and this recent market downturn provided a great opportunity for that. I dumped Tesla and some of the other stuff because the thing is, the dividends are great. It's like a 70% dividend yield, but when it's all said and done, when you factor in the NAV erosion, it ends up being a CD rate of return in a record bull market. So that's my big concern. And honestly, my message to them, it's not like I'm not hating on them. I'm just saying do better. Produce a fund, lower yield, more stable NAV. That's really my message. Do better, you know?
Yeah, I think
Yeah.
that they should own their flagship ones. So the ones
Yeah.
that they're always pushing. So for example,
Yes.
Yield Max should own, and I'm not talking like just own like $10,000, not even 50.
Hmm.
I'm talking like a million.
Yeah.
Like some of these fund managers, because they get how these people get really wealthy, and that's why this industry is so lucrative. If you do it right, is if you have a fund at like a few billion AUM, you're pretty much set. You're printing money, a lot of money.
Right.
So when they give out distributions from their corporation, that's when they're getting a big payout. So I think that they should have at least a million in their flagship products. The people who own the firm, right? Maybe
Right.
maybe not the PMs, because some of the PMs could be like making way less money, but they're making really good money. But for like yield max, it should be like Ulti, Misty. Round Till should be WPay at least, right? Or even WPay. Define should be like what? I don't even know like what's their top one. Maybe like their two times a
Probably
week one. Granite here should be
QQQY
like
or yeah.
by TQQI or
Yep.
NDYY. Neo should be SPY Triple QI, like at least a million for the founders of the firm. That's
Yeah.
just my opinion.
I actually wouldn't mind if they own some of their leveraged funds too.
Oh, they're definitely gonna own
Yeah.
it.
Yeah. Well, some of them, it's funny because talking about reverse splits, which I was going to bring up, on the one hand, I was kind of shocked by the timing of the yield max reverse splits, but on the other hand, with some of the leverage funds that are out there, I'm like hoping for a reverse split. Especially there's Defiance's SMCX, and then there's MSTU based on MSTR. Um, those might actually need reverse splits to like save the funds at this point.
I know if you shorted or you bought the inverses, like if you bought Winter or the inverses of the MicroStrategy 2x long, then you would have done really well. I know some people who have been doing that. So
Right, right. Speaking of, so MSTU, obviously the underlying is MSTR. Apparently, someone has called the bottom for MSTR. That would be good news, I guess.
yeah, I mean we can only hope, right? I
Yeah,
feel like we thought that the bottom for MSTR was last week, and then the next day was
right.
like -10%, and the next day was like -5%.
Yep, it keeps
So
setting new lows. It's just like SMCI. It's like, all right, I get it. They missed earnings, but they keep getting punished.
yeah.
Yeah, we've got Health and Wealth on. Welcome. We had some comments about the fund managers owning their own shares. He says they protect themselves, so not in their name. He says fund managers do, they keep them under their name. Okay. And then thoughts on Yield Max's target 25s.
Oh my gosh, it's like, bro, I don't think that ETF issuers should have a target
Hmm.
for their products. Like, oh my god, I whenever I see all this stuff, I'm like, I have a lot of hot takes on it, but for the target 25 ones, it's like you're just defeating the purpose of being called yield max,
Right.
right?
I know they've kind of branded themselves that way, but I'm telling them too, I'm like, we need more stable NAV. Like, if we could get high yields with stable NAV, I mean, it would be like having your cake and eating it too, but that would be awesome. Like, if we didn't have the NAV erosion, after the high yields.
Yeah, I mean, if I think it just defeats the purpose of having your name be called yield max.
Yeah.
So yeah, they're gonna want like more growth on the fund. I get it, but I don't know if they're doing it on all of their single stocks because then like some of these underlying like the volatility of the underlying individual stocks are going to vary. So why do we need target 25 for all of them across the board? It makes
Right.
no sense,
Exactly.
right? So that's like saying, all right, we're going to do target 25 and then it's going to be the best for Costco or Netflix versus like a MicroStrategy and like an Nvidia. So it just like it should change and vary. They should have like a variance of it. So just call it like the yield max income fund or something like that, where they have flexibility on the yield of the underlying asset because the volatility is going to just vary.
Hmm.
Because when you're just keeping it at 25 and the volatility is falling below that, then all these complications come around in the fund. But I mean, cool. Yeah. I mean, just gives people more like it's like a menu, right? Like when you're an ETF company, you want to have like a menu, right, of products. So maybe this is a good one, but I don't know. I think it's going to make everything more complex.
Yeah, I agree. One thing I never heard anything more about that I know was mentioned in New York was the LevMax suite of funds. I guess that's still, pending. I don't know if it's gotten approved or not, but that was definitely intriguing.
Yeah. Was the left max supposed to be like a leveraged of what YMAX or what?
It was leveraged funds that like they capped the downside and they could be as much as I think 2 or 3x to the upside, but they were going to reset monthly. It was really
Hmm.
intriguing when I heard Mike Venuto talk about it. It was really intriguing.
I think like the best leveraged ones are going to be by Neos for sure.
Yeah.
For sure. There's gonna be no daily reset. I think you don't want this will be like a fun fact for people. So like when you have a company having like leveraged ETFs, just go with the direction and go with their pro shares. Don't maybe granite shares, but you don't want to go to these shops that have like less than a couple hundred million in AUM. Just you don't know what the swap fee is. The swap fee, it's not even in the prospectus. It could be like 15 to 20% expenses that you just don't see. It's just taken out of your
Hidden,
NAV,
yeah, hidden
right?
expenses. Yep.
Just hidden expenses.
Hmm.
So some firms that like can't compete with the rates of JP Morgan, like I'm not gonna say smaller shops, but like you can there's no way you could compete with like Direction or Direction and then pro shares on that. There's just no
Right.
way. So whenever I see like smaller issuers have like leveraged with income or just leveraged products, I'm like, just go with the big dogs. You'll save a lot more money.
True. True. Yeah, I think like what you mentioned with Neos with no daily reset, that's huge. If they can eliminate that, that's massive.
Yeah. I think that one would probably be like the most exciting one. I think that's
Hmm.
probably the only one I would personally own, just
Yeah.
because I need more risk. I need more reward potentially, but also
More reward for the risk.
I think
Yeah.
there's more downside. So
Oh yeah. Well, like as we discussed on your channel, so I'm a growth investor, but I've become like a leveraged growth investor, which works great when the market's going your way, but when it's not so great.
yeah,
So,
I'll have a comment like right now. So I remember I would ask some of these portfolio managers like we become great friends.
mhm,
So sometimes it's like hard for me to um like talk to them about stuff like maybe like not personally, just like questions about the market, right? I'll call them like, hey, like, what do you think about the market right now? And they'll just like tell me about it. But a lot of them told me like, hey, Marcos, you should own like 2x, 3x S&P Nasdaq 100. And I'm like,
those actually the TQQQ, which just split by the way. I think it
yeah,
was a 2 for 1. I think that one's phenomenal. And the
yeah,
UPRO,
yeah,
the 3x direction or pro shares for the indexes, I think those are phenomenal.
yeah. So like a lot of these portfolio managers have, like, believe it or not, they have, or a lot of Wall Street fund managers have a good amount of their money, not all of it, but like they got some exposure to leverage products. So 2x, 3x, Nasdaq 100, S&P 500, and they're just like buying on weaknesses and trimming it on rips, and then
Hmm.
they're just taking the profits, putting it into money market fund, short-term duration T-bills, and then they're just cycling it because they just know. I mean, in April when the market crashed, do you think that they bought like VOO?
Mm,
No, they bought like T triple Q, U Pro, and they were just riding
absolutely.
it. So
Yep.
it's good for them.
I did that in May actually when I rolled over my 401k because I was in like you, I was in the growth funds, and when I looked at how the leveraged ones did, because if you believe long-term S&P 500 is going to be up, Nasdaq's going to be up, then why not? You know, it may not do exactly 3x because it has that daily reset, but it's still higher. It's still higher than just the underlying.
Yeah, I mean, it could do more than 3x when you think
Yeah.
about it, because the way that the math works on the upside. So if the market is going up and up and up for the past decade, you're not doing 3x, you're doing like 6, 9x
Yeah.
because of the way the compounding works.
Hmm.
And so like the argument is like you shouldn't own leverage products because of the daily reset or of what volatility drag. But that's more argumentative for sectors that just move sideways. So I'm like oil's a big one. Just sectors that are like very cyclical. So you don't want to be in leverage in those. You kind of want to get in and out. But with broad market leverage products, then they could do pretty well. Which is why I think broad market leverage with income is going to be a good choice for investors.
Hmm. In fact, I have the chart here for TQQQ over time because these were founded basically after like the '08 crash. So like
Mm-hmm.
by the time the market had started to recover by like 2010, um, was when the main suite of these were founded. So one of my favorite charts to look at is the QQQQ over time, and look at that, 21,300% over the lifetime of it.
Yeah, and that's more than 3x the return
Oh
just
yeah.
because of compounding.
Hmm. And then even over 5 years, I mean, we obviously had 2022 here. We had a pretty steep decline here. When it drops, it's as you know, it's hard to recover. It makes it harder when it has a steep drop like that. It takes longer for it to recover. But you can see here, this year, it took like what 7 or 8 months basically
Yeah.
to
I mean, it
recover.
would technically make it harder to recover if you had cover calls on it.
Yeah. Oh yeah, because you're capping your upside.
Yeah, right. So I'll give you an example of, of like a ETF that I think won't go back to its all-time highs, like
Hmm.
a blocks, for example. You could pull up BLOX by Nicholas Wealth and title.
Yeah.
That's the one where, it had quote unquote like no NAV erosion up
Hmm.
until a certain point, right? And then when the market just so it went up, right? Ethereum was doing well for them. It think went up to like $27 a share, and then the market corrected with crypto and whatnot. They had a lot of leverage names that were going down, a lot of the treasury companies, and then it just fell like a knife. And a lot
Yeah.
of people are thinking, all right, it's just 60% returns to go to the upside. Just to go back to all-time highs, it's going to go up 60%, right?
Yeah.
That's incredibly difficult. But also the fact that it's paying a 36% yield makes it harder for it to go back to all-time highs. So my
Exactly.
theory was like, there's no way they're going to see all-time highs again, like ever. They have to. This is also why I think firms shouldn't target a yield. They're targeting 36%. So when they're falling like that, they're stuck to that 36% yield.
Right.
Like to just lower the yield, protect your NAV, mitigate the NAV, and then let upside, be less of a burden on you.
Hmm.
But
It's funny, every
that's my
time I
opinion.
hear like a yield over like 20%, my inner growth investor's like I don't want my dividend audience to be alienated, but that's like you said, that's handicapping the upside of the fund.
Yeah,
Yeah.
yeah. I mean, there's products that have like zero DTEs, which are more risky cover call products than the 30-day ones, but zero DTEs that have like a 14% yield on the Nasdaq 100. Those have been performing way better than the zero DTEs that have like 30% yields.
Hmm.
So like I would rather have the ones that have the best total returns. But even the Qs, a lot of people say, oh, like the Qs are like super concentrated. Maybe you are right. I also think that the Qs are very interesting because you are limiting yourself to just one exchange
Hmm.
versus like an SCHG, right, by Charles Schwab. You have both the NYSE, which is the New York Stock Exchange, and then the Nasdaq Stock Exchange. Versus the Qs, you only have the Nasdaq, which is basically like concentrating your risk to like one exchange.
Hmm.
But it's done well. I mean, the reason why the Qs have done super well is because you have large cap, mainly tech companies that have high free cash flows, growing the revenues more than the market, and you're seeing stock performance. So for me, it's like I love having. I think I have like, I don't know, 80K in the Qs right now.
Yeah. Yeah.
Um, so I love the Qs. I love anything that has large cap, tech, and growth. Like
Mm.
sign me up for anything like that has that type of characteristics.
Yeah. When you were picking your 401k funds when you were working, did you like how quick did you figure out that like those target date funds were underperforming?
Oh, within like 2 seconds. I
Yeah.
saw
Yeah.
target date. I'm like, I don't care,
Yeah.
right? I learned about target date funds in college. So there were some really cool classes at my university. I went to UC San Diego.
Hmm.
I majored in economics, minored in finance, and then yeah, like target date funds are really for people who just want to just set it and forget it. Maybe they're like lower risk,
Hmm.
so want broad diversification. Just don't have to like rebalance their portfolio and like go into like bonds and whatnot. So yeah, it took me like 2 seconds.
Yeah. That
I,
happened to me
I just
too.
found the most aggressive one. The most aggressive one was literally VTI. There was no more aggressive products. So it was like VTI, 100% of my exposure. And then I think every quarter I upped my 401k allocation to like 10% of my paycheck, I think, at
Yeah.
one point.
That happened to me too. I think within like the first 2 months that the 401k started, they defaulted me to like the, target date 2055 fund or whatever. And I was like, wait a minute, this is doing 8% and the market's doing like 30%. Something's like way off here. And so I found large cap, I found S&P, like NASDAQ 100. They were JP Morgan funds because that's where I worked. But yeah, I was doing like between 20 to 30% per year, even during years like COVID. It was like that was like a 30% year for me, even with all the choppiness of that particular year. Um, but yeah, that was a quick discovery there. Um, and then when I rolled it over, because I moved to a new firm, and then I roll it over, and I'm like, now I can do like whatever. I can do options, leverage. It's a lot of power at your fingertips, but it's also dangerous at the same time. So
Yeah. Or you could also move, like a pro tip for people is like if you want the target date fund, just move it farther out.
yeah.
Like if you don't want pure exposure to like 100% no target date fund, just move out the year by like a decade or something like that.
hmm Oh, and then I think there was a minimum to contribute to the 401k, so it defaulted to the minimum. Then I upped it to 10%. Then I ended up doing the legal max, because when you approach six figures, you start to realize like your taxes and all that. And I was like, I'm just doing the maximum, just max it out. Quickest
Yeah.
way to grow it. Because in 10 years, you max it out. That's at least almost 250,000, and then you add all the growth on top of that. That's a quick way to grow wealth.
Yeah. I think people, when they invest in ETFs, which is the channel that's all I do is ETFs,
Yeah.
they forget about like which accounts are the best, but also how to minimize your taxes. So if you want to minimize your taxes, don't go into high dividend products, and
Yep.
then just pure growth, and then max out your 401k, Roth IRA, and try to lower your taxable income. I think this year I'm going to owe like 50,000 in taxes.
That's actually not bad. I mean, that's a
Not
lot,
bad.
but
Yeah.
like, well, I mean, this is going to be my biggest tax year too, but
Oh, there we go.
I started seeing most of the gains come in like the IRAs and stuff, but that brokerage account,
Oh
that's
yeah,
where
because
I'm
you
going to
have
get busted.
trading. That's why.
Yeah, yeah.
That's why.
hmm I
Mm.
mean, it's funny because like, I mean, I have no state income tax here in Florida, but like the more you make, the more you pay in tax. Especially options on these ETFs are basically short-term tax, so it's your marginal income rate. So, like I said, this month I'm reducing my tax bill a little bit because I'm actually tax loss harvesting.
There we
Well, look
go.
at this. So you come on, all these other YouTubers show up. We got Rod on. He said target funds do the double dip on fees too. Scams. Yeah.
Mm.
Yeah. And well, in the 401k, so the expense ratio in the 401k funds, at least from what I saw, because I know there's a lot of hidden fees and stuff like that, but they were very low expense ratio fees. I think the small cap ones, oddly enough, were the highest.
Hmm.
Yeah. Speaking of fund managers, I did reach out to two of them and ask about reverse splits.
Well, which ones can you say?
Yeah. So Sylvia at Defiance, I asked specifically about SMCX because
Hmm.
that's one that's dropping a lot, and then Rec Shares. So Sylvia responded. Rec Shares hasn't responded. But Rec Shares has a fund called MSTU, which is dangerously close to. It's like a dollar something right now, so it's approaching dangerous territory.
Yeah, they're gonna reverse split that for sure.
They got to, yeah. This commenter says, I notice Rec Shares has an issue with HOII. Okay. Oh, something I want to point out. So he said Max Convexity did a video about the fund managers, how they own stuff, but it's like not in their name. That's what he's claiming, is that the fund managers own it, but it's like not in their name. I guess for liability purposes, because in case they get sued, maybe they have it in a blind trust or something. But you referenced, like off the record conversations where some of them actually say they don't own it. That was what I thought you said.
Yeah,
Yeah.
they're like
So
no.
right,
So I'm
right.
sure I've seen now where I'm like, oh, like you're the PM of this multi-billion-dollar product. They're like we got like barely exposure to it. They
hmm
can never tell you like a dollar amount. Like if someone has like 3,000 shares of LT and they're
Oh,
a
this
PM,
is yeah.
like
Sorry,
oh,
but this is a
no
huge
worries.
relief. His comment.
I mean, if someone has like 3,000
Yeah,
shares of LT and they're a PM,
yeah,
like that's a lot. No,
yeah. I know.
like
With the money they're making, like you said, that's nothing. It's a
they want
drop
to
in the
have
bucket.
like I said, like give me like a 250,000 at least
Yeah,
exposure.
yeah. This is actually this news here that Rod just shared with us is a big relief. I
Hmm.
figured they would. I thought they had to, but they didn't answer me. I reached out, they didn't answer me. So, what's his name, Scott? Um,
Hmm.
Yeah, but that's awesome. I like you said, they had no choice.
What are your thoughts
Anyway,
on reverse splits? Do you think it's bad for like the income products?
well, here's my thoughts. So I was mad because if I recall correctly, Jay, I had him on my channel like 5 or 6 times. He said specifically, he said they would not do another one. He said they would liquidate the fund before they did another reverse split. Now I get it. I get at the point some of these funds are at, a reverse split is absolutely necessary. But I'm not a fan typically, except I guess there's some caveats to this because obviously I like it with MSTU. I have some holdings in MSTU, so it's like I said, it's approaching a dangerous price. So sometimes I'm okay with it, but when you have funds that consistently decline in the NAV and you keep reverse splitting, people are just they keep buying in, you're just losing shares. And what concerns me is a lot of this dividend audience ignores history. So like Ulti, all these videos over the summer and all of these discussions about how great Ulti is. But I kept pointing out, like back in 2024, which is still only last year, it's almost 2 years ago at this point, but Ulti started like in the high 20s and it got all the way down below $5. So I think that's relevant. The former price of a fund from what it's declined from, I think that's relevant.
Yeah, I mean, I think with reverse splits, it's bad with a fund like Ulti or even like ULTI is not performing well. Do you own any UMX funds? Yeah, I
Yeah,
owned.
yeah,
Yeah, I owned. Are you Are you wanting to Pacific Capital?
I like that.
Yeah, yeah, I owned Ulti for a little bit. Made a like 22% gain. Got out.
Nice.
Still holding my
Yeah.
Misty from a few videos I made. So still like down like what 45, 50%.
Yeah.
But even then, like I said, like my fund, I think I have like $350,000 all in growth, like
Mhm.
VOO, SCHG, AOTG, QQQM, like VTI.
Right.
Like that's all I do, and I just buy and hold. And I don't care about like the price. I'll buy all time highs. I'll buy like $10,000 lots at a time. But I mean, if you're young, I firmly believe you should be just pure growth.
Right.
Just and even like the conversation of like, oh, should I switch over to like income products when I'm like about to retire? Yeah, I mean, I guess if you want to do that, maybe like Neos is probably like the best for that. Goldman
Mhm.
Sachs has some good products for that. But if you're younger, just go with growth and maybe
Agreed.
not like I guess the argument is like saying, oh, let's go with Roundhill. Let's go into Roundhill products, like because we're young.
Mhm.
I mean, I guess, but like, do you think like WPay is a good product? Because they're just like owning all the weekly pairs. Like, there's no methodology behind it. They're not like stock picking. Like, there's no actual thought process of like which are going to be the top holdings and why these stocks should be included in the basket. Which is why
Right.
I love like the S&P 500 is the way of picking stocks, or AOTG's way of picking stocks, or these growth funds, like high quality, profitable companies in the baskets of these ETFs versus like I don't know, you got like ULTI, which has been like a falling knife.
Yep.
You got what WPay, which it just holds like all the weekly pairs. Like, what if you have a weekly paying ETF that you just don't want to own?
Right.
Then you got to
Then
create
you're
your own
still,
basket,
yeah. Right.
and then you got like OT where you don't even know like what they're doing. You got like I think the best max income product I think right now is KYLD by
Mhm.
Curve. That's just my opinion. I mean, you need to take into account the experience of the fund managers. So like some of these fund managers have like their portfolio managers has like limited experience, maybe not the best experience. I think Howard's doing something pretty solid with KYLD,
Yeah.
and he was at PIMCO for a while, which is a very prestigious firm.
Absolutely.
PIMCO is out in Newport Beach, which is near where I'm from,
Mhm.
and yeah, it's super hard to like execute some of these products. And I'm gonna be blown away if Curve can, but I don't think Rex can with the ULTI. I
Right.
don't think Ulti is coming out to the conclusion that we have to own high quality names like what Nvidia. I think they also own Salesforce, Costco. Like, they're just
Mhm.
like doing their own thing. So it's super hard, man. these cover call products are like super hard to execute if you're just stock picking, because I think I had a tweet out. I had one tweet that got like a lot of hate. It was like a statistic that said that hedge funds are like, I think that it was like 70% of hedge funds or like 80% of hedge funds like fail over time.
Yeah.
And Ulti was like, okay, we're a hedge fund. This is like a hedge fund ETF. I was like, wait, but like 80% of hedge funds fail after like 5 years,
Yep.
before a 5 year mark. So like, what makes you think that you could successfully do it, right?
Right.
And then I had a tweet also, or a Blossom post that said like every yield max product eventually will reverse split. And then people were like, why would you ever say that? Like, you're a horrible person. I'm like, I'm just saying the truth. And then like 2 months later, we're seeing a good amount of them reverse split.
They have to, because they drop over time.
It's just the high payments, right? Like,
Yeah.
if you have a high payment, you're gonna reverse split eventually, unfortunately. But it's also the risk you're taking, right? So if the fund does well or the underlying does well, you're gonna get rewarded with high income. If it doesn't, then you're in for a wild ride.
I did a poll of my audience, and 11% of respondents said that the reverse splits were a great thing. The options were, are they great? Are they bad? Or are they like necessary but unfortunate? Yeah, 11% were like, yeah, they're great. Like, we want more. So
I
that was
think they're
interesting.
not great. I feel like they're
Yeah.
necessary. That's the right term.
Yeah.
Necessary. Not great for the funds that try to mimic some sort of performance,
Hmm.
right? Like a Ulti, for example. Like a Misty, it's just doing what it's doing. It's paying out the maximum income you can.
Right.
Eventually, you're gonna get to the price so low. I mean, when a fund distributes like 3% income, it's gonna fall by 3%. You
Yeah.
do that over time, 100% yield, you're destined to reverse split at some point.
Yeah. Well, and my thing with Tesla, when I finally determined like these aren't for me, even in the 10% bucket, when Tesla hit all-time highs, I mean, a couple months ago it was up to like 440, almost 450, and Tesla barely went up at all. It was like $8 and something. So I'm like, there's basically no upside to these funds.
Yeah. I mean, it's hard for it to move when you're writing on calls on basically the whole thing.
Hmm.
So like at least leave like half the portfolio. Like I think Neos does like at least, but Neos varies how much they do their calls. Usually like half of the portfolio is like uncapped.
Yeah.
But yeah, when you're writing it on like the whole thing, then it's hard for it to go up.
Hmm.
Unless you need to have super sharp moves, right? Like I think AMDY is a prime example of like you need the underlying to shoot up like 20% just to have some meaningful moves. Otherwise, you're just gonna fall.
Yeah. But anyway, yeah, no, I'm in agreement. Growth is the way to go. And even, if you like dividends a lot, I've always said take your own dividends, sell a portion of the growth, and then pay the long-term capital gains rate. It's much more tax efficient, and you're getting what you want. You're getting that payout that you're creating for yourself instead.
Yeah, I definitely agree with that. But that's also for people who started, earlier in life, built up a big portfolio, then they could do it, right?
Hmm.
Like 3 to 5 million net worth, 10 million net worth. Just sell the shares, take your own dividend. You're going to be fine. And then even then, if you have like a few million, like how much do you think? I asked a fund manager did this. I'll tell you guys. Like one time I was in a car with a fund manager, and I was like, he was driving and stuff, and I was like, how much money do you think is like enough to retire? Like a good lifestyle in America. How much do you think? So I'm gonna ask you a question. Like what he said.
He probably definitely said in the millions. Maybe, I don't know, for the average person, was he
Just like,
saying
just like live a good lifestyle.
5 to 10 million? No.
40.
40. Okay, I knew it was
Like,
high, but
what?
I'm
He's
thinking
like,
like for him or for the average person.
for like, I guess for to give live like crazy, like good lifestyle. But most
Okay.
of these portfolio managers want who like own their own firms, like they believe in taking out living on 2% of the portfolio.
Hmm.
So I mean, the Grant shares. I can see the live chat. Yes. Well, when the coach pulls up, but
Yeah.
Grant shares too. Like Grant shares, they're paying out 150, 100% yield. It's gonna fall, right? And it's not to blame like yield max maybe or like Grant shares on that. It's just like that's what the fund does.
Well, a lot of these companies, so Granite shares, like I haven't touched their yield boost stuff, but I love their leveraged funds. Same with Defiance. They have a couple of my favorite leveraged products, but as far as the like high yield products, I haven't touched those.
Yeah, I mean, Granite shares is built on leverage products. Like that's what they're doing. Like that's what they're best at. I
Mm,
think that some of the issuers they should be known for what they're best at and
yeah,
stay away from what they're not good at.
yeah,
Right. So like, it would be weird if we saw, I don't know, a direction or like a pro shares come out with, well, maybe not pro shares, but direction with like their own cover call product. Right. It's just going to be like, maybe they could do it better, but it's like stay in your own lane if to what you're good at. Right. Like if
right.
Vanguard or Fidelity came out with their income max cover call product, like it's going to be like so weird on their brand. Right.
Yeah, exactly. No, I think that yeah, when they have a certain niche like that, they've got to stick to it. Uh, to this point here, I actually think right now in this market, like a lot of growth stocks are at a great buy point right now. Meta, Microsoft, AMD, even Nvidia to an extent. There's a lot of great buying opportunities.
Yeah. I think that the biggest hindrance to some people is like, should I buy now or should I wait?
Hmm.
I think with individual stocks, it's kind of a more of a timing issue
Hmm.
than ETFs, where it's just like buy whenever you have the capital. But yeah, I mean, if you see a lot of value in an individual stock, then I don't see why not.
Hmm. What I do sometimes, I do covered calls on these growth stocks because I do want to get called out of them and wheel into something else.
Mhm.
Um, So, and sometimes like today, I have a stock called Datadog, and it dropped. So my covered call, it expires today. I was able to buy it back and not get called out of the stock. So I love when that happens because like extra income
Mhm.
on top of the stock.
There we go.
What's this? Did you notice Rick shares LII ETF paid 80%? Oh, interesting. I don't follow. There's so many of these, like we were saying, I don't follow them all.
Yeah, I mean, I'm hoping that I'm pretty sure that's Eli Lilly, but
Yeah,
I hope that it did really well. If it didn't
right.
do well and you paid 80%, like, bruh.
Yeah, something's wrong for sure. Well,
Yeah,
it's like what was the one that was all the buzz? Was it Hui? I mean, Robinhood. I mean, look at the underlying; it did great. Just like
it,
Palantir
that's
having its
valid.
run up. Yeah,
Now that's valid. If it's paying out high distribution and the
hmm,
underlying is doing well, valid. If it's
yeah,
like, I don't know, if it's giving out 80% on Costco,
hmm,
bruh, like there's no
exactly.
way. Or
Yep.
80% on Walmart. Like Walmart's not underlying vol. It's not that vol. It's not, and that's my gripe with like the yield max target funds is like if you have a low vol product, high vol product, they're all going to be 25 across the board.
Right.
That's not how you should run a shop like that. It should all just vary, just depending on the underlying vol.
Exactly. Yeah. Well, that's pretty much we've been going about close to 45 minutes here. Any last comments or anything for the audience?
Oh man, oh, it's been such an interesting year. I
Yeah.
don't even know what like next year has in store. I'm like preparing for like, like what's the content going to be like for next year? What's the news going to be like for next year? I feel like this year was I would have never expected like all these products coming out and whatnot. But I just think that people should stick to what they could understand and comprehend and buy on the dip and buy on the rips too, and just be long-term investors and not freaking out of like owning, I don't know, everything that comes out. Like I mean, I don't know if you have a thought process on this, but like some cover call investors own like 40 products or like 35. I'm like,
Yeah. Way
how
too
do you
many.
guys manage all this stuff? Like they're owning like everything, but I don't know, just be long-term investors, health and wealth.
Hmm.
There we go.
Yeah.
Long-term investors, and I'm always a big believer of like growing your income outside of your portfolio.
Yep.
Growing your income outside of your portfolio, saving or investing a good amount of your paycheck, not looking at it, just increasing your income, being a good person, and just being a long-term investor. And I
Yep.
think that that's going to be like the most success for a lot of people.
Yeah. No, that's it. 100%. You gotta work at least for a few years, build up the income, invest in growth, like you said. Yeah, that's Makes total sense. I am bullish on next year. I think that we're going to get a new Fed chairman. Well, I don't think that it's going to happen. We're going to get a new Fed chairman, and then they'll probably start cutting the rates more aggressively. I'm hoping we still get a rate cut in December. I'm hoping we at least have like another year of bull markets. I'm hoping. I always
Yeah,
make the joke. I say, let the market just keep going long enough for all my stuff to recover. Then it can crash. No, I'm just kidding.
yeah, that's always the case, right? It's like,
Yeah.
oh man, I want to, or even some people like they're just waiting for some big bounces on their underlying stocks just to get out
Hmm. Right.
of their funds.
That's what I
So
think's happening, like with SMCI and some of these, because I've been watching every day on some of these, waiting for a recovery, and it will go up and then it starts to sell off massively, and then it goes up again, and then it sells off, and I think people are just getting out of it when they get a little breathing room.
yeah,
Yep. But anyway, all right. Well, great. Thanks, Marcos, for coming on. It was great. For the audience, check out his channel, check out my channel, like, comment, and subscribe, and join Discord. And we'll see you all in the next one. Take care. Bye. All right, end stream. So this will end. That was really